Good morning, everybody. Welcome to the Flow Show. Busy day going on at the moment. Oh, I feel out of breath. Morning, boys.
Morning.
Hello.
Morning.
What's one doing today?
All good. All good. Lots of moves going my way. I hope they're going your way, guys, and all our folks in the room.
I think it was a good day. I think we read it quite well going into it in the chat room for those of you who were there. But yeah, we'll talk about that.
Yeah, we'll get stuck into that. So obviously the FOMC is a big thing to talk about. So let's crack on through with some of the headlines, and then we'll get stuck into that. Starting in China, and China's MOFCOM, Ministry of Commerce, says China is willing to work with Australia to manage differences. So again, more signs that they're going to pal up again, and that's going to be a bit of a boon for Australia if that continues. Domestically, they also see foreign trade development situation as extremely severe. Imports and exports are facing extremely severe environment on slowing external demand, and vows to overcome difficulties in order to boost consumption. China are probably going to go hammer at tong at seeing their economy picking up, exports, imports, all sides picking up after the virus wave. So we should be expecting some decent economic bounce coming in from there. Over to Japan, and BOJ's Deputy Governor Wakatabe says that the spring wage talks are a key event for the wage outlook. But there is absolutely no change to the BOJ's current commitment to continue monetary easing. The spring wages are a key event for the wage outlook, but the outcome of the wage negotiations alone won't be enough to determine whether the BOJ can phase out stimulus. So he's not expecting the wages to be a significant factor in terms of what the Bank of Japan do. Obviously, it still remains to be seen what happens with wages, and the market is likely to push its expectations based on the wages. But as far as he's concerned, that potentially is not going to affect the Bank of Japan's stance. So that's a potential bun fight to come between the market and the BOJ as we get towards the end of this quarter. Then said need to be cautious about another widening of the YCC band. They are seeing signs of inflation heading towards the 2% inflation target, but not hitting it in a sustainable manner, and not yet convinced this will actually happen. So very much in the Kuroda camp from that guy there. Coming across to the US, there's not been that much news out from elsewhere. Fortunately, the BOE and ECB still on blackout, and fortunately the Fed, I think they stay on blackout until at least Saturday, so all quiet from there. ADP came in with a bit of a surprise number to the low side. We were expecting 180k, it came in at 106k. Got the market in a little bit of a tizzy over that. However, the chief economist at the ADP said in January, we saw the impact of weather-related disruptions on employment during our reference week. Hiring was stronger during other weeks of the month. As you know, we've been banging on about this since the last NFP report, that the weather may have an effect on the number which we get this Friday. So factor that in. If you get a big bad number, the market is going to react. But if it's weather-related, you might find that the market reverses whatever it does after the algos get stuck into it. So be careful with this NFP tomorrow. It may not be exactly what it's all cracked up to be. Over at the ISM, the numbers came in, well, a little bit mixed. And we'll just take a quick gander at those on the cow so you can see what we're talking about. So the headline number came in a bit softer, 47.4 versus 48 expected, so further into contraction. However, the prices paid metric, that inflationary metric, moved up some to 44.5 versus 40.4 expected in a prior of 39.4. Employment also moved higher than expected, staying in expansion. It was still down a little bit on last month. New orders fell as well, so that was down. Again, maybe some weather-related shenanigans in that as well. But overall, you know, the components that we thought might be weakening or should be weakening didn't. Employment was still up. Prices paid a little bounce there. So it's not out the woods in terms of whether, you know, inflationary pressures from wages and stuff are going to subside or whether they're still going to have an input into the inflation picture. The JOLTS numbers as well, another big jump that had been creeping lower over the last few months, but boom, it's rocketed up to 11.01 million. These are December numbers, so potentially some seasonality in there. Obviously, a lot of hiring goes on in those Christmas holiday periods. So maybe one we need to look at for the next report. Canada, their manufacturing PMI bounced into expansion at 51.0 versus 49.2 prior. That was that from the data front. So let's get stuck into the Fed. So they went the hike as expected, and Powell reiterated that they have more work to do. They will keep ongoing hikes, maintain ongoing hikes, and will likely have to maintain the restrictive stance for some time. He said the Fed are strongly committed to bringing inflation back to target, but will need substantially more evidence to be confident inflation is on a downward path. An interesting comment, he said that he can now say for the first time the disinflationary process has started. A pause of rate hikes is not something the FOMC is on the point of deciding right now. We are talking about a couple more rate hikes to get to the appropriately restrictive stance. And according to the current outlook, it will not be appropriate for rate cuts this year. Now, also some comments on the financial conditions, saying basically that they haven't seen a big change in financial conditions and that they're mostly unchanged since the December meeting, but that it's important that markets reflect the tightening the Fed is putting in place. Now, did the market reflect the tightening the Fed is putting in place? Not according to some of the rate futures. The terminal rate fell to under 4.9%. So that's where the market thinks the terminal rate is going to be. So under 4.9%. And you'll recall the Fed's dots are somewhere in the 5% region. And a rate cut was priced in by the end of 2023 because Fed funds futures for that period went below 4.4%. So the market is still not taking Powell's word for it that rates are still climbing and going higher. Now, one of the things we did need to squeeze out through all that was how many rate hikes are likely to come. And it seems potentially 2, as he said there. The reason being, if we go one more 25, that puts the mid rate at 4.88%. So that's again below the Fed ceiling. If we go 2 hikes, that puts the midpoint at 5.13%, which puts it spot on to the Fed's current expected ceiling for rates. So he's touted 2. We're going to need to see that he gets to 2, and then we'll see what happens after. Are they going to continue? Is that their pause point? And what's the market going to do with it? I think from here, the market is saying we're at the end of the hike process, whether it's 1 or 2 or 3 or whatever, it's saying we're at the end. The next thing we're going to be pricing significantly is now going to be these rate cuts. This is going to be the bone that the pivoters have been chewing on for a while, and I think now they'll get their teeth really stuck into it. And when we see rate cuts. Currently, and just before I bring the guys in to give their opinion, next meeting, we are pricing a 25 pip hike as an 83.5% probability, and unchanged is the other side, 16.5%. So no more pricing 25s and 50s, we're pricing 25s and unchanged. So guys, it's the end of the road, isn't it, for the Fed and their hike cycle?
Looks like it. I don't know if do you mind if I go first, Kay?
Well, you already have, mate. So carry on.
I already have. Okay.
My guest, so I
what,
can rest a little bit.
what I said yesterday ahead of the event was that I didn't think Powell really had reasons to upset the markets by being more hawkish. You could argue that some of the things he said were a little bit on the hawkish side. Oh, yeah, we're committed to fighting inflation, etc. But then he did say maybe a couple more hikes. He didn't say several, didn't say, let's see how many, he said a couple, and they choose their words wisely, I think. They always do. So what is the market pricing? One more, maybe one and a bit, but I think we're very, very close to the end now. And that's the message that Powell is slowly giving to us. Now, the question is, will they start cutting at the end of the year or close to the end of the year? I don't think so. We need to see a lot more happening. So I think in that respect, the market may have it a little bit wrong within quotes. The market's always right. But I think we need to see inflation really plummeting and economic activity, well, it's already started going south, but employment also needs to start dropping for them to consider cutting this early. I'm not saying it's not possible, but I just think we need to see a lot more evidence. Maybe the market's already anticipating that by pricing the cuts, maybe. If that's the case, well done, market. But for me, yesterday's Powell was overall not as hawkish as the dollar bulls and risk bears wanted. That's what I wrote on the chat room as soon as the statement came out, and actually in the presser. I mean, after the statement, the market was not really doing that much. It was really the presser that moved. And yeah, I wrote on the chat room, I said, look, if you're a dollar bull and a risk bear, what you want to see. This is not what you want to see. I would be scared if I was short equities on the back of and seeing what Powell was saying on the presser. And I did say at some point, look, guys, I think we're going way higher. And in fact, I've been banging about silver 24.50 on a daily close or 22-ish, low 22s. Well, at some point in the chat room, I said, that's it. I'm buying back my half position at 23.50, and I got it in there, and but I'm just riding the whole position now, average 22. So I'm happy with that. I just think that for the short term, this is definitely an indication now that they're going to be stopping pretty soon. Is it going to be one more cut? Sorry, slip of the tongue. One more hike and then they stop? Yeah, I mean, it could happen. I think if this month's CPI is a big disappointment, they're going to, they could say, let's take a step back, see how this develops. They have no real downside in doing that. If inflation starts galloping lower, that's not the right word, is it? Starts crashing lower. Freudian slip, yes. Starts crashing lower. If I was the Fed, I would say, okay, let's see. Our tightening has already put a big break onto the economy. Let's not kill it before we see where inflation is going. It doesn't hurt to wait for one more meeting and see if we need to adjust, But anyway.
But doesn't that hurt their credibility again? Because they've told us rates are going up and staying up. They told us rates are going to 5%. Pretty much every Fed dot is at 5%. If they stop before that, doesn't that just feed into the bears and the doves?
Well, if they have proper evidence, strong evidence that A, inflation is dropping very fast, and B, employment perhaps is also dropping. If we get a bad NFP number today, I think that will probably give them more how do I say it, opportunity to do that. But anyway, in any case, I think that we are very close to the end. The Fed have told us that. So the path of least resistance for me remains to the upside. It doesn't make too much sense to be buying stocks here because of valuations, because things are escalating in the Ukraine. They're talking about sending F-16s, F-18s, F-somethings. FUs, yeah. I mean, this is serious. You're sending you're effectively engaging now against the nuclear power, which is a big nuclear power. This is a serious escalation. So theoretically, the global environment is not good for stocks. Yields have gone up quite quickly to decent levels, 4.5%, 5% from zero. And there's a lot of uncertainty and recession potentially coming. I mean, this is not good fundamentally for stocks. At least it wasn't good until 2008, right? After that, everything changed. So I would say, the path of least resistance, if you put a gun to my head, I will still buy stocks. I'm not saying it makes sense. I'm just saying that seems to be the path of least resistance. And that's what we've been saying for days now. And this is manifesting. So that's my shorthand 20-minute answer to your question.
That was longer than one of Steve's. Over to you, Kate. Give us your thoughts.
Yeah, okay. Thank you. That was it for me. Now, okay. There's a bit for everything. I think to me the major non-hawkish facts were twofold, and that is and nobody really, and apart from myself, nobody really talked about that in the chat rooms or even not that I saw anywhere else. Is they changed the one word, and that's the pace of tightening into the extent of tightening. That is one thing. And then the other one, and that was already in the statement. To me, it was all in the statement, really. Okay, Powell, of course, gave the market the green light, but it was already in the statement. And the second thing was no change to any of the tightening measures, such as QT and or other interventions on the RRP or so. So you see, right in the middle of the statement, you're saying determining the pace of future increases, and it's been changed in determining the extent of the future increases. That gives them some leeway to, and Powell said it's not the base case for March, but I've seen also, I think it's JP or so, Morgan, who said it could be that they actually pause in March, and all the messages that are non-hawkish are just taken by the market because the market wants to sell dollars. And now in his press conference, he did speak about a couple of hikes. Well, first of all, he said several, but then he said a couple, once or twice. So that should bring us into their dot plot average range of 510. But as Stelios was already saying, if inflation comes down rapidly, which may be expected, they will have leeway to slow down or call for a pause or whatever. The other one, where I think we have to look for as a reason for some assets going up, like equity markets, metals, is that the latest data are clearly showing that the soft landing is now a real possibility. Okay, we may have like call it accountant recession somewhere, but the data show a clear soft landing is the real possibility. So that in turn is good for assets, and then the correlation trade is higher assets, lower dollar, higher stocks, lower dollar, and stuff like that. I'm actually a little surprised that the 10-year is still holding above 340, because not having changed anything to what could affect the further end of the curve. I would have expected actually the 10s to try to get below and hold below. We had this dip earlier in January, but yesterday we didn't go sub 340. I was actually a little surprised, but so I think the correlation was there yesterday. Now, and the last thing, and that has less to do, well, it has to do, of course, with the Fed, is that the rest of the central banks are catching up. If you look at ECB will probably do 50, and then the BOE will probably do 50, although the sterling is wrestling with different issue. They are actually catching up. So that's an extra little reason why the market is looking at the soft side of the dollar, and it's the soft side still in the market. The ease with which the euro dollar yesterday broke above 109.40 was telling, right? And we haven't revisited yet. Now, globally, to me, I think this can continue for a while, but I still refuse to think the dollar is completely dead. If we really get a soft landing, that should, in theory, bring down the the inversion of the yield curve, because the longer you go, the more the market, if you get a soft landing, if it's not too bad for the economy, the longer end of the curve will hold up, and the shorter end of the curve will just trade inflation and Fed funds and stuff like that, PCE and things like that. So in theory, if you get less inversion of the curve, it should actually be quite good for the dollar, but that is something much further down the road, I think. So those are my findings of after the Fed meeting. I think for the time being, we should be buying metals on dips. We should be lightly buying equities on dips as well, because of this combination of possibly pausing, lower inflation, and a soft landing. So the combination is positive assets, right?
Yeah, exactly. I mean, my further thoughts is okay. So we know we're getting to the end of the Fed, and we know what the ECB are doing. We know what the BOE are going to be doing, at least by the end of today. You know, we're creeping towards the end for those guys as well. You know, I don't think the ECB is going to hike for all this year. The Bank of England could be 2 more and done. We know Canada's paused. We know the RBA were talking about slowing. They may have to go a bit more based on the inflation, or they may still pause. So we are potentially coming to the end of this phase of tightening from central banks, which means we need to be trading what is going to happen next. Now, as you said, with the Fed, the trade is on when are these banks going to start cutting again, and that's all going to come down to the data, which is why this first part of the year and probably the second part of the second quarter of the year going to be very important for that, because that's going to set the expectations. Those situations, though, that data that we've got coming is going to decide where the next big trends are going to come. Euro dollar's looking pretty strong, but where's it going to top out? And as Kay says, if it's going to be a soft landing, then the dollar is going to start to pick up again, because if other countries start slowing but the US is holding up, investors go back to the dollar again, and we see it go around. So I wouldn't look at any of these moves if you're running longs in the euros, if you're trading the breaks or anything like that. We're almost going to be getting to the end of those paths as well. So this big trend that we've seen here, you know, a lot to do with the Fed pivot, but also what's been happening in the Eurozone going into a hawkish mood. You know, maybe we get up to something 112s, maybe even 115s, and that's where the story starts to peter out. So, you know, I wouldn't think at all we're getting anywhere like 120 or anything like that here and now. So if you're trading for more longer terms, you've got to think, when's the party going to stop for these guys as well? So let's talk about the moves then. You know, we've been highlighting this area. I've been highlighting this area from 108.30, 70, and then up to the 109s and the 109.40, the line in the sand. And we've broken it. We've gone above. This is going to be a key area if we come down. Bit disappointed not to see the 1.1 break holding. So we're not out the woods just yet. But if we find support coming into this 40 area, 109 area, and it's holding, that's your clue that perhaps we are going to continue a bit higher. And, you know, where can we go from there? Maybe 111, maybe 112 is not out of the crosshairs. I've got a big long-term trend line coming in here, which is at 111.32. So we have got some levels coming up above, but this could be a very significant break. And what you want us to look for is confirmation of that break. Aussie dollar, another one, been waiting and waiting and waiting for, and looked like we got a break of the zone, looked like it was held here, then started holding the top side, but we failed, or we're looking like we're failing at the moment. So again, I'm waiting for this one to push on up, so I can start taking some profit on my longer term longs. But at the moment, we're not out the woods. Where's the line in the sand? The line in the sand is now down to 71, 70, 80. If we get down there and hold it, it keeps all this in play, keeps this break in play for a move back up. If we back under here, come the end of this week, then all this is looking like another fake out. And that's a further sign that the market is getting itself done on what all these central banks are going to be doing. It's happy where it's at now. There's no need to push it further. And obviously, if we get back down further under 70, then there's a real risk that all this becomes a very big top, and we're then maybe going to head back down somewhere down here, 68, 67s, even further. These, when you look at charts in the short term, they tell you a picture. When you look at charts in the long term, bit of a wider picture, look how strong this trend has been. These things don't last forever. So if we can't make hay at these highs, there's only one other way these prices are go. So as much as I'm long and happy for it to be breaking up here, I'm also cautious where the party is going to end. And it's been breaks all round. Finally got the break. Euro sterling, another one. All of us been waiting for this one. Clean break, even got through the fib, this 50 fib here, but the jury's still out. We're still mooching around the fib. While we hold 89, it keeps this break in play. And then perhaps we're going for a lot of our targets up towards 89, up towards 90. Next level for me is up around here, up towards the high 89s, 89, 70, 80, then into 90. And we got another big fib up there as well. Stel, you obviously been looking at this one, same as I have.
Yes.
If it wasn't for the summer holidays and me getting out because I was just giving money to the broker down here, or down here it was, I'd have still been sitting in longs from, down here. I was long from down the 83s. So it's been down here. So it's been
go on.
Yeah, go on, mate.
No, I was going to say I had that trade, not in a large size. It was quite small, but I got out at 88.3. Remember when there were big headlines about Brexit? Again, I got suckered into it, But anyway, it was a good run, and I've kept saying I still think we're going to 90. It's just that it never gave us a pullback over the last couple of weeks, to buy it. So anyway, I think obviously we have the ECB and BOE today. They could move things around a little bit, but the target for me has always been 90, and we're now really, really close to it. So even if we don't get it, I'll chalk that up as a success, and we move on. But fundamentally, the pound. There's nothing to be bullish about the pound, at least not at the moment. There will be a time, I've said this for weeks now, will be a time to be very bullish the pound, not now. And also the ECB, for now, they're telling us that we're going to be doing more 50s plural. So well done, Bran. So as long as that's the case and we have this central bank divergence, there's no reason to go against it. As you said very correctly before, at some point the party ends and you get a retracement. But I think the retracement, not on the euro pound, because that's pretty much hit the target, but on euro dollar and all the other currencies that are breaking out, we will get a retracement. But I think that's going to be a buying opportunity, at least until from my point of view, until the fundamentals change.
Yeah, it's a difficult one to gauge here because we are seeing some breakouts, but again, we have got the ECB risk, which should be pretty quiet because we know what they're likely to do. But we have got the NFP, and that can turn everything on its head, depending on what the number is. We get a really strong number, and all these dollar bears who are selling the dollar today might be thinking, I'm the wrong side of that because jobs are still posting strong numbers. Conversely, we get a weak number. and the market sells more dollars. So it's one of these situations. These breaks are good if you're running with them and you're in them, but you need to still be aware of the risk that things can turn around. And I want to look at cable as well and get your guys' opinion, because it didn't follow the others. It got a move, but only up to 124 and couldn't get through that. So no breakout for cable, and it's the weak link today. Why do you think that is? Is it just a BOE risk coming up? Is that why cable's not following the others?
Good question. But I just think, as I said before, there's no reason for me on a fundamental basis to be bullish the pound, and that's I think why it's underperforming. Now, why today specifically? Maybe some repositioning ahead of the BOE. Maybe some. I don't know. K, Europe.
Just look at euro sterling. I mean, euro sterling is all you need to know. And yeah, we've also seen weak retail sales in December. The market is probably still thinking or still thinking of a risk of a BOE only doing 25, and then we have Magic Bailey on the wires today, and the day Bailey talks, cable crashes away. So a Bailey a day keeps the pound away. Yeah, I think it's just a combination of factors, and also, and I don't want to hang too much my hat onto it, but yesterday we had this EU thing saying that this Northern Ireland Protocol stuff is still not done because they want the ECG to rule the legal stuff of all this, and that's a no-no for the UK, as we know, since 2016, right?
Yeah,
it's just a combination of factors, I think, and if you look at the level on the cable where it held again around 124, this whole 124 figure 40 zone is pretty important. And late last night I was just looking at it when Asia opened from a distance, and then euro dollar shot through up to 110.30, and Cayman never managed to make it above 124 really. So yeah, I still think no reason to be very bullish sterling either. As people know in the room, as people know here, I'm long euro sterling. Now via options, I let my cash go just in case, but I still have an option running a call at 88.5, which runs into the end of the, well, nearly the end of the month. So that is doing the heavy lifting right now. Pretty happy. We're in a bit of a magic zone here for me on the euro sterling. I've always said 89, 10, 20 is the gateway to 90, the figure. So that's where we are right now, going into the duet of Bank of England and ECB, where we should have a hawkish ECB still. The risk for ECB is that the market has been trying to price 3 times 50, and I think it may be overdone. So that's the risk for today, going into the ECB. But then we have equal risk on the Bank of England that Bailey is not happy about the economy. He's a poor sour sod, and he's probably not going to be hawkish at all. If he's hawkish, that would be the surprise trade of the day in the sterling, in my view. Yeah, so I'll have a look at a couple of levels quickly going into there. Yeah. But yeah, I'm still bearish. I'm still bearish sterling, and I think euro sterling goes to 90, and why not even beyond that? I don't know.
That'll be nice indeed. I'll just put a link up there, because we obviously talked about the ECB and the risks from there, and the Bank of England. That you can find more of that in a blog post I did earlier this week, so check that out there if you want a bit more info on that. Just looking at some of the comments. Abir got a nice short in Guppy, 161. Very well played there. What can it do from here? At the moment, you're on the right side. you know, you've got to think, unless there is a shock from Bailey, it's either going to tip further. I can't see it rocketing higher unless there is a big shock. So if you're on that, you know, ride it, my friend. You know, I hope you've taken some profit on the way down. You know, maybe ride your stop behind it on a trailer. So if there is a shock, you're locking in your profit. You're not going to give anything back. You're just going to not make as much. You know, and if you get down to this 157s area, that's somewhere to look as a support point. You know, if that's where the price is going to pull up. I'll let Cage on take over, and I'm sure you're going to talk about €1 CAD. It's
yeah, there's a couple of interesting euro crosses going around, right? So and a couple of sterling crosses. I also saw the question about sterling yen. I'm going to have a look at it.
Yeah, no worries.
Okay. Right. First of all, cable. This just to show that 124 again. I know you guys know we were looking at those levels, but if you look at this little support trend line, it was around 124. We tagged it late last night nearly, and we shied away again. And there's a bit of a support here around 123, the figure. But I think more importantly will be the one that we saw last week, around 122.60, 122.50. This one is about around. So I reckon this afternoon after the Bank of England, this is going to be the level. And if it breaks, we could be trading mid 121s pretty soon, depending on what happens partially on the dollar, of course. And then top side 124, figure 5, figure 10, and then the prior one around here, this 124, 45, 50. That's really going to be the key. If it's really breaking, that means that there's likely something wrong with the dollar. Euro dollar, as we have already spoken about many times, 109, 109.40, depending on where you were looking at. The red line as well, it finally gave way. There's a bit going on in the mid 110s, and then if you look at the more medium term, we're talking about 112, 112 and a half. That is being a more medium term target, in my opinion. Could be doing it, you know, on a bullish hawkish ECB. And we've got, what have we got? We've got, do we have PCE out today in the States or tomorrow? Tomorrow is NFP day, of course. No, we don't have.
No, we had PC last Friday, I think.
Last week. Yeah, tomorrow is NFP. That's going to be another danger point for the dollar, of course, especially that we have those revisions of 2022. And if I saw that correctly, Ryan, do we have a different accounting system for the NFP?
Yeah, they're doing something with it, changing it, so it's not going to be a reflection of December. Let me find a.
All right, I'll let you look that up. It was a bit strange the way they formulated it, right? But we do.
Yeah, they're doing some changes. We've got the revisions coming as well.
Yeah, we should have the revisions for 2022, and as we've already mentioned a couple of times, other measurement tools were way below job creations than what the BLS declared in 2022. So the market will monitor that closely. So be ready for the NFP tomorrow. It could get a little bit messy. In the meantime, the metals liked very much what was said yesterday. We are back into the zone, 24.35. We're trading 24.30 right now, so we are retesting the trend line. Give it a little bit of leeway up to these prior highs, right? But if those start to go, then why not dream about levels of at least 25s? Silver can be a fast mover. High 25s, and even why not 26s somewhere in there.
Music to my ears, thank you.
Yeah, I mean, mine as well. I must say, yesterday late I bought a few, and then I sold most of it out already because I didn't really know what was going to happen overnight. You never know, but it's rare that we walk in the morning and that metals are lower coming out of the Asian session. They usually buy metals, those folks, right? So and we are trading still well bid. Oil, sorry, no. Gold, still very big. But I would like to really see what's going to happen if we get into this 1975-85 zone. It's going to be pretty important up there, in my opinion. But yeah, it's big. The other day we held bang on the 1900 on multiple support there, and we're already $50 higher. So don't change a winning team. Perhaps be a bit careful if today we could 38.40 perhaps in this little zone. 38.40 could be a bit of a level to monitor, but for the rest, this still looks very big. And then I want to talk about the sterling. And first of all, the question about the sterling yen there. And Ryan already looked at it, but yeah, selling around 161 was a really great trade. I think we have to look at what's happening around these prior lows here. 158.5. I don't remember who was talking about the sterling yen. Sterling yen. Where? Oh, that's quite a bit higher. Oh, Abir, yeah, 158.5 and then 157.5 on the way down. Okay, those are the levels you should be watching. If after the BOE we get down to 155s, you never know. That's going to be quite a monstrous level, in my opinion. So if ever it gets down to 155, I think you should probably reassess a little bit, because it may mean that that means that sterling will have already weakened a lot. And I'm not sure if the market is going to be completely one-way ticket on this one. As far as the other side of that pair is concerned, yen, I'm very neutral for now, but I do keep an eye on what's happening in the euro yen with ECB. And this trend line in particular, I'm looking at, and we tested it this morning and failed again. So I'd keep a close eye on what's happening in those 140, high 141s, low 142s. If this could go and close above this little zone, I think there is food for thought and perhaps reason enough to go and try higher levels. I might try to catch a knife if ever we get back down to below 141 and towards the 140.5. I'm neutral on yen, but I think yen is starting, even though the dollar is weak, but the yen as such on the crosses, I'm not sure whether the market is ready to buy much more yen, especially with those officials commenting that they may not want to really change too much to what's happening. Euro sterling, as I said, and I don't know, have I already showed this? 89.10.20 magic zone, that's where we are, and the gateway to me to 90 the figure, bit of extension there, 61.8 of the big drop. Back down, this is going to be an important level again up here in around 90. But we'll see what happens after the BOE. So pay attention to what's to the close, I'd say, today, above or below this 89.10.20. If we get some temporary setbacks, 88.5, that's where my call is actually. I may start to unhedge it and start to actually get long cash again for a final push through. What else? Oh, this one where I'm a little really small got in there is Euro Noki. I bought it yesterday again, and I've bought it yesterday again here at this level on this little level here. High 1083s I bought, and I let some of it go at 1090 on the end of the European session yesterday, but I still got a little bit. It looks breaky to me. It looks breaky to me. If we start, and I was hoping to buy more around 1070, but I'm not even sure if we're going to get it. This looks breaky to me, and there's not a lot. There's perhaps something around 1102, but this could have a run retest of the 1120s, in my opinion, providing the ECB keeps the hawkish stance. Euro-NOK is a different issue altogether. What else? Oh yeah, the EuroCAD. EuroCAD. We're back. We're back. Let me just go on a slightly longer time frame and adjust my things. Again, this is this morning. Did we run up to 146.30 again? That was when I was off. Jesus, we retested it again, 146.30. So 146.30, 40, 30, 45, still magic level. We failed again. So that's already a triple top only in the past 2 weeks. So be careful with this level. If ever it would start to break past the ECB, I don't have anything running in it right now. And the more we test something, the more chances are that we're going for a break sooner or later. And I'm keeping an eye on what the oils are doing, and they are looking a bit sluggish. So we may set up for a break here. I don't know. I'm not going to fight it right now. I will see really after the ECB. If the ECB door is not as hawkish as the market may expect, then this thing could go all the way back down to 144s. And I'm going to leave it there unless somebody wants to talk about something else.
Well, I was going to say on that Euro CAD, it's a great level. I'm not sure I want to trade it ahead of the ECB though.
No. I'm going no. Ahead of the ECB, it's not a good time to trade anything. But it is a monster level, right? It really is a monster level. You can go back into early 2022s. It held once for the final spike. Then we went below, retest, failed, retest, failed. And we have already 3 retests in the past 2 weeks, and we are failing again. It's really a big level, right? If that would go, I'm not even sure we're going to stop in the 147s if that goes. We could be looking at
that's what I'm thinking. If the ECB bring us a break
up to the 150s, maybe even. If this breaks, it's going to go. It's going to run.
I don't think I'd go a break by stopping it for the ECB in case you get flipped out, but if you get a break and you get a chance that it confirms, I think that's something to look at.
Yeah, if you look at it from a slightly more medium term, you can also just wait for the close today and see if it's above or below.
Yeah.
And even if you miss 50, 60 points, so be it. There's probably another 200 after that. This could be a bit. This is a really strong level. Gav saying 6 times already the test. It's a big level. I mean, there's no way around it. It is really a big level. Okay, that's it for now. Euro Swissy. I don't really even want to think about it. It's doing its own thing for now. And this one. No, I wanted to show this one. This is the differential in the short end, EU versus dollar. And if you look for a reason why euro dollar is trading around its tops, look no further, right? This is a differential, and we are on pretty important levels, and we can go back even all the way to 2016. Look at this traffic zone that we have here, which was built around minus 150 pp's. Look at here, we were in this zone. The breakdown and the retest stopped at minus 150 pp's, and we are back into this zone. So this is one to watch out, and this is what I was talking about yesterday in the chat room as well, and on Face, is that this is probably going to determine where the euro is going to go, at least for another while. If the ECB is hawkish enough, this could break, right? And then I think you don't want to be short euros, and it could drive, and it has already driven the whole eurosphere. If you look at stuff like euro yen, despite the dollar yen collapsing, euro yen has, in my opinion, been holding relatively well, barring the big spike lower yen driven. Euro sterling is holding. Euro commodities is slightly different, but then the euro cat, for instance, is coming to retest that zone as well, and this could be really a driver for more to come. If in turn ECB starts to go away from the more hawkish tone, we never know with Queen Suntan, this could cap and go back down, so the interest rate differential widen, and that's probably going to signal at least an intermediate top on a lot of euro pairs. So I'd really keep an eye on that one after the ECB. So that's it for me, Ryan.
Thank you very much, mate.
Sorabria, I think we're breaking up.
Yep. Cool. Yeah, I mean, I think one thought for Lagarde later is, and I repeat what I've said previously, they won't, or she won't, let financial conditions ease like the Fed have done. Fed have brushed it off. The ECB is a different kettle of fish. They are very hot on making sure that their policy transmits into the economy. So that's something to keep an eye on, that she does talk with a really strong, hawkish, bullish attitude towards that going forward. She has sort of pre-committed to these 350s. So it will be a bit of a climb down if she goes against that. But I think as far as financial conditions concerned, they're going to be very strong on not letting those dip too far back, and that will keep the euro supported, any conversation like that. Right, just before we wrap things up for the day, just want to highlight our offer that we have for Forex Flow here. You can grab 20% off the price of the ForexAnalytix platform. The big discount has disappeared that we were running on that, but you can still get my exclusive offer there. I'll pop that link in the chat for you. So if you do want to join us here in the chat room and see all the goodies that go on underneath, please feel free to do so. On we go again. I just want to say, I think for everything that's going on this week, where we close Friday is potentially going to be very important moving forward. If we're holding some of these breaks into Friday, closing above the breaks, then that's going to be very good for those pairs, assets, for continuing those moves. If we can't close above those, we stand the risk of going back into the well-trodden ranges, and the market is happily pricing what it wants at that time. So for all these events, trade around them, in and out, whatever you like, but just keep an eye on that close on the Friday, where we finish, because that's, as I say, likely to tell us where we're going to go from there on after. Right, we shall see you all bright and breezy tomorrow when we go over what mess the Bank of England and ECB have left us. So I wish you all a great day ahead. Thank you to Kay, thank you to Stel. We shall see you all tomorrow.
Alrighty, safe trading, guys.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.